Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to try to help you with your retirement, especially in the financial sense. With the retirement planning, how to manage the assets, how to tax plan during your retirement. And so, whether you're already retired or looking forward to retirement at some point, the things we're going to talk about here, I think, can help. Some of them are kind of evergreen, like managing the assets and those types of things, and some of them are going to change as tax laws change and things along those lines. But we started this channel because we felt like there was a gap in the educational area. Especially wanted to try to educate our clients, which just makes everything easier. We found that the people that understood more, we felt had better rates of return altogether. So, you can go to our channel, you can subscribe, you can hit the little bell there that will tell you, notify you when anything comes in that we put in new. And so also, if you want to just meet with us to ask us questions, you can do that through a book appointment. And of course, you can ask questions here as we go live. We have two different ways to do that. Ask Tom at talkmoneywithtom.com is the email address. You can send those in now, and we'll see those and try to answer those questions live. Or if you're signed into the Google channel here, you can actually use the chat and put in a question, and we'd be happy to answer those also. So, that's our format as far as that goes. We really enjoy those of you that can join us live. And obviously, we do put this out as a recorded version too, so you can see that. Each Friday that we have the show, I try to do a summary for what I saw happening in the stock market this week. And we've been working with this particular chart for quite some time, kind of goes back to 2018. And I keep that in there because that was the first dip right at the beginning of this chart. I think it was 19.6% from high to low. That was around the tariff time. That was the first term for Trump, for example. And lots going on here. It's kind of incredible, right? We had the big pandemic drop and all these things, and yet the market is still up quite a bit from 2018, that's for sure. This week, it looks like market might be down. Today's kind of rallying back as we go. I think I saw a negative 1.2% at one point in time, and was less than 0.2% down the last time I looked just before the show started. So we'll keep you up to date on that. But we've not had a lot of negative weeks. As a matter of fact, they were talking about this week possibly being really the most negative it's been since April during the Liberation Day downturn. So let's talk about why that is. Seemed like things were going along normally, and then I believe it was on Tuesday, the CEO for Goldman Sachs, the CEO for Morgan Stanley came out and said, the market's overvalued. We're expecting a drop. And then we're talking more like that 10% type drop, just to take the heat off. I'm all favor for those. I mean, if you look back just over my shoulder there's a drop that happened in the summer of 2023 that really, once that was over, catapulted the market upward, in a very fast fashion. When you get these, I always talk about the rubber band, right? So, market's going up and up and up. You're stretching the rubber band. There's more and more resistance to that. So when you get really stretched out, you're going to have more of a snap back. If you don't stretch it that much, sometimes the snapbacks are less, right? For the same thing, you can go the other way. It can go down too much and then snap up, right? And so you're watching for those. There's actually different measures for those. Wilder's RSI is one way of looking at that stretch and such too. So when we look at this particular market, it has unbelievable momentum to the upside. There's no doubt about that. We're still in a primary direction up. We have been setting higher lows all the way through this period since the bottom of the Liberation Day, situation that happened this year in April. And we've had, very small pullbacks all the way through. We're still trading above the 50-day moving average. We're still trading above the 200-day moving average. The 50-day moving average is still above the 200-day moving average by quite a bit. So these are things that we look at and say, okay, the rally is still on until proven otherwise. And so we very much so would think a drop of some type here is actually healthy. I'd rather see, that lessening the tension on the rubber band, so to speak, so that we might not have as big a downturn at some point in time. And you can maybe continue to go up at a more steady pace, maybe farther than you do when you stretch the rubber band that much. Because what happens when you stretch the rubber band, basically you're stretching valuations. and all of a sudden you could get a situation where a lot of people start to contribute to the downside and trying to get out, and then pretty soon everybody else is seeing that, and you could get a snowball effect. And that's what always bothers me about these markets that pull up a lot, is that snowball effect to the downside versus one that's more steady. You don't get as much of that snowball to the downside. So I wouldn't be surprised to see a pullback here, just because we did have such a great September and October altogether. And September is, going back to 1928, is an average negative month. It's the only one. And so we had a really good month. Matter of fact, that was true last year also. Both times we had rate cuts. So I think it sort of artificially pushed the market up. And just my gut feel, just from my experience, I don't have data to back this, but when we have a really good September and October, November can be a little bit weaker. And November is the best month of the year, historically, right? So we do have seasonality on our side, yet we're looking at negatives. Okay, it's still early. We're not done with the month as far as that goes. But so one of so that was the first portion that seemed to get things going, was the CEOs talking about the downturn. And there's a lot of respect for what these, especially big bank CEOs, say, because of their access to everything, to commercial credit, to private credit, to home loans, to car loans, to and they're seeing, hey, what's happening here. We can see consumer behavior. They have credit card data that they see. I mean, this is a group that, Jamie Dimon's another one, right? You kind of want to pay attention to what they're talking about. And I'm not surprised at all that the market didn't respect what they were saying and kind of have some softness this week at least. And then the next thing that happened, we don't have the government reports coming out like we used to because the government's closed, but we do have some other reports. So the ADP report came out, which is ADP is a payroll company, and they actually said there was 42,000 new jobs created for last month. And that was a lot better than the previous 2 months where it was actually negative. And it was above expectations. So the market actually stabilized on that day and did well, but then I think that was Wednesday, and then Thursday we get this report saying that there was 153,000 people laid off in October, and that's the highest we've had in 20 years. Yeah. And so now the market was responding to that. Generally speaking, the market has responded positively so far to negative situations within the labor market, because it means that they might be lowering interest rates, right? But there is a point in time, especially with that number, when you get 20 years worth of data, and this is the highest layoff month we've had in that 20-year period, the market's going to look at that maybe as a negative in this particular case because it's big enough. So let's talk about why that happened. And I'll switch back to here just so we can chat for a second. If you look at the layoffs, what you're hearing a lot about is like AI. And people that got AI and people aren't getting a job. Just from what I've been reading and the different things that I've watched, most of the people out there who know what they're talking about are saying that AI isn't at a spot where it could create 153,000 job loss, right? It's just not far enough advanced to be able to do those things. But there are two potential, depending on who you listen to, reasons that are farther than that. One is AI related, and that is that these companies are spending massive amounts of money trying to build out their AI infrastructure, whether that's a data center or software enhancements or whatever it is. But they're public companies, so they still have to produce higher earnings and meet expectations for those earnings. And so they're cutting costs.
Yeah, Meta is a good example of that, where Meta, was hit for their earnings being lower than expected because of how much they were spending on AI.
Yeah, so I think that's kind of reverberated actually through this week, because that was last week, and so it's reverberated through where it's like, these companies are spending a lot on AI. It could be affecting their earnings because there is no revenue from that AI. It's all spend, which is very similar to what happened with the internet. Everybody had to buy infrastructure and do all these things, and even data centers and cloud computing kind of eventually came out of that too.
Yeah, with a lot of the social media companies, it was all about, it didn't really matter how much they were spending as long as they were getting eyes or users on the product.
That's right.
Before they had revenue.
Yeah, because Facebook didn't have revenue, they didn't have earnings, and until later, and the revenue was fairly small compared to the price. It was just about how many eyeballs you could get. Yeah, so the spend on AI is causing some of these layoffs, There is some productivity enhancements that they were talking about, but it's not that great. But the people that are there are able to do more, and so there's been kind of a freeze across the board. They call it a low hire, low fire environment, and so we're not seeing tons of firing going on until October, in my opinion. But we're not seeing a lot of hiring happening either. You look at the different reports, again, private reports from companies like Indeed. So Indeed is doing kind of the report, what we call the JOLTS report, which is the big jobs report that comes from the government, which would have come already. As a matter of fact, I think it would have come today, I believe. Anyway.
Yeah, likely it would be today.
And it's not here. So we're looking at these other reports, and it's showing, some decreasing in, job postings as far as that goes. So the other area is tariffs. For those companies that are exposed to tariffs, again, they're trying not to pass along all of the cost of the tariffs to the consumer. I think more and more we'll see more and more of the cost move to the consumer. That's what's been expected, and that's what's already is happening. However, again, still trying to make the earnings. They're also cutting back in their costs because now they got a new cost, this tariff, and we can't, and one of the areas they're cutting back in is the area of labor. So kind of the combination of some replacement. There has been some replacement of AI. If you're in a call center and in different places, there has been some direct replacement, but there's some of that. There's some of the spend on AI and then the spend on tariffs. All of those are kind of coming together to create a situation where you're getting a much higher layoff picture.
Yeah, they're making the workers that are still employed are more productive, and so they're able to do more, basically, so you're able to do more with less.
Right. So it's interesting, and we'll see how that continues, right? Because that probably just the beginning of that as far as that goes, and we'll see how that plays out. And so I have an interesting analogy that I've been working on this week that I'll kind of share with you. So basically, let's pretend that water is coming into the economy. And if there's more water coming in that can drain out, the economy is going to grow, stock market's going to grow, right? And it doesn't have to even be the economy. It could just be the excitement about, what is happening. And so the water that's coming in, and I'm using a fire hose here because it's coming in at a really high rate, is the money that's coming in that's being spent on AI, specifically the data center build-outs, but there's going to be all kinds of different things that are pieces in that. And so that is essentially, now we look at like a drain, okay? So if the drain is all the things that is going to suck the water out of the stock market, suck the water out of the economy. So if you have more water coming in than the drain can handle, the stock market's going to go up, right? So here's, rough example, kind of a drain that's being overwhelmed by water that's coming in. And so let's say the drain is all of the things that we're worrying about, okay? Tariffs. Deportations, independence of the Fed, the government shutdown, and, all of these different pieces that are just keep piling up, right? And so right now, the drain and all those things we're worrying about isn't enough to take all the water out of the economy and the stock market because of the fire hose that's coming in, right, from this data center and AI build spend. And it is the biggest thing by far. Without that, the economic growth is essentially zero in the first half, right? And so that's the analogy. And so here's what you want to watch for. If the AI spend starts to drop down, like if you had a garden hose instead of a fire hose of AI spend coming, now the drain is sucking all of the water, right? All of these things that we were worried about, even if they don't get bigger, can still drain the water out of the economy, and we could end up with a stock market that comes down, more than the 10% that the CEOs are talking about. And so really, the other aspect of that, if we go back to this drain here that's being overwhelmed, is the drain just grows. Even with the fire hose coming in, tariffs could knock it out, theoretically, right? Historically, tariffs have been really hard to deal with over the long term. That's why they don't stay up there very, very often, or ever, really, or at least since the 1913s when they started doing income tax. Because it is a tax. Matter of fact, they basically hammered that home. The Supreme Court, case that happened today, which we'll talk about for a second, but, they're convinced, the administration is trying to say it's not a tax, but the Supreme Court, they don't believe that. I don't either. And so And so if you look at it, we have two taxes. We have a federal tax and we have a tariff tax. And prior to 1913, we just had the tariff tax, yeah? And so tariffs were higher back then. But since 1913, this is the second highest tariffs we've had, and the others were 1930. But we're very, very close to 1930 levels. And so you could see a situation where even if the fire hose of data center stuff comes in, the whole, the tariffs, the deportations, the independence of the Fed, the government shutdown, all of these things just start to build up, and they create a drain that can handle and take the economy out of the stock market. And so that's what we're watching for. We're watching to see, does the AI build out start to moderate. That is a little bit about what has been talking about this week in this downturn. There's some worry about it. Everybody's worried about the fact that none of the AI people are making any money off of AI per se. I mean, there's some productivity gains. I guess you could say that's making some money. But a lot of the projects are still struggling. We'll see how that plays out. But really, it's still, as long as the money is flowing out from these companies and from these, from every corner of the world really is really driving into these things, because people can see the potential opportunity, whether that opportunity comes or not. So I think that's pretty fascinating. That's a good way to look at it. Does the fire hose continue?
Please try again.
Uh-oh. Sorry. Does the fire continue, or does the fire hose continue, or does it drop down? That would drop the market, right? Does the drain, the things that we're worried about, do they get big enough? They're not big enough yet. They're mostly because they're probably delayed. And maybe they don't get big enough, honestly. AI spending could become 2 fire hoses for all we know, right? It could continue to grow even faster. We'll see what happens. But I think that's a good analogy. Now, there was a case where the Supreme Court heard arguments on Wednesday. I listened to most of that, and very interesting. And I was a little bit fascinated because there has been a lot of, information coming out of the Supreme Court backing the current administration. This doesn't look like it, at least at the moment. They haven't decided yet, but there were 6 of the 9 people really asking, I thought, questions that led me to think that they were going to vote against this. And what they're looking at is whether or not these tariffs are legal. They are looking at them in the sense of taxation is handled by Congress. This is a tax, and the president shouldn't be able to do taxation. Specifically, the founding fathers didn't want the king to be able to unilaterally decide on tax, which is what the problem was. That's what the Tea Party was about to a large degree. And so that's their main argument. Now, the problem is that they're not looking at the other part of the argument, at least so far, where they're looking at this, it's supposed to be for emergencies. And so, honestly, if you look at the administration, I think they're kind of fudging it a little bit on what's an emergency, yeah? And so they're not going after it in that regards. And the problem there is because of these other tariffs that are allowed, they also revolve a lot around the emergency concept. So, for example, the line item tariffs, where you can go for steel and aluminum and such, and so the president has that ability to actually set up a tariff. So that's allowed. That's a problem with the current piece that they're using now. It doesn't actually say anything about doing tariffs. It says regulate, not do tariffs. But they do have others that allow the president to do direct tariffs. But again, it's sort of on an emergency basis. So steel, aluminum, pharmaceuticals, semiconductors, they're going to try to say that everything's at an emergency, maybe because of trade deficits or whatever it might be. And so if the Federal Reserve if the Supreme Court does not rule on this particular one on an emergency basis also, not just the fact that it's not tariffs, but the fact that it's also not an emergency, right? You can't say Brazil should have a 50% tariff higher than the other countries that are around because you don't like the fact that they're prosecuting a previous president. That's not an emergency, right? So I would prefer if they actually addressed the emergency portion also, because that would help on these other cases, because likely we'll end up in the same spot again on these line item tariffs where they can do, because what is the emergency for that as far as that goes, and so because it's supposed to be it's an emergency to protect a particular industry, right? So if you're going to line item tariff semiconductors, well, we are the industry. We're the ones that everybody in the world's worried about. If you're going to line item steel, okay, yeah, maybe, because we have a harder time making steel at a competitive price compared to the rest of the world.
Yeah,
right?
they've done it back in 2019
Yeah.
with
Right.
washers.
But it would be more limited in theory, right? Than what is probably going to roll out, which is they're going to try to tariff every single line item they can find, right? To try to get back to this 18 to 20% kind of net tariff situation, because so the net result is if they take this away, all of these tariffs that we've been talking about, 80% of them. I mean, the China tariff, the negotiation that they've had to they've reduced tariffs, last week and what have you, it goes to zero, essentially, except for the line item things. So anything that was done under the emergency piece that wasn't a line item piece would disappear. And depending on what the the Supreme Court does, do they require a refund, right? Historically, that's what's happened. There was a refund plus interest. Now, don't expect any of that money anytime soon, because apparently the last time they did this, and it was much, much smaller, it took a couple of years to get it back. However, that's going to be very fascinating to see how the market responds. Because on one hand, just disappearing tariffs, you just got rid of a tax. Companies are making more money, right? Theoretically, prices could come down, all right, because they've been increased because of the tariff. And so that could be great for the stock market. On the other hand, if you have to refund all this money, the bond market is where they're going to have to go because it's not sitting on the sidelines.
Yeah, we've already spent this money essentially.
Well, we should have because we're running a deficit, right? So, that's going to affect the bond market because they have to issue these bonds. Maybe it won't if they do it over 3 or 5 years. Who knows, right? So anyway, these are unprecedented situations. We haven't had a Supreme Court ruling like this before. We haven't had, actually, Donald Trump's the only one who's ever used this particular emergency declaration and applied tariffs. He did it in 2018, and he did it now. And he's the only president, and this thing originally came into play in 1970. So the betting market, right, which is the place to go if you want to see what the results might be, because polls and other things don't seem to be as accurate as the betting market. I think because when you put your money down betting one way or another, that's a lot more conviction than answering a question in a poll, right? So the betting market was more accurate on predicting who the next president was than the polls. And so the betting market right now dropped down to 25% chance that these tariffs stay, 75% chance that they go away. So I think that's what a week, really. All these things that are happening, and this is, unfortunately every week's kind of like this, right? It's incredible, lots to talk about. So anyway, that's our outlook. Watch for the fire hose, watch the drain. Don't just think that because the drain's there that everything's going to fall apart. If the water coming in is higher than the drain can handle, the stock market's going to go up, and that is what is happening right now, right? So the fire hose of money being spent on these data centers is outweighing any of the other concerns that the market might have. Now, that can change, but that's how you watch it as far as that goes, as far as we're concerned. And so, right now is the time to kind of be in there. We still have money out. Main reason being because when this thing snaps, it could snap quite quickly. And it might not snap, but if it does, it probably is going to be pretty quick because you'll start to get some real fear. I mean, we're even seeing it in the cryptocurrency market. I think most of the gains that came from 2025 have disappeared, and that's, a market that moves a lot faster. And, the stock market may follow, that whole concept also. So anyway, that's what's happening today. Thank you for joining us for our, summary as far as that goes. Look forward to being able to do this again, summary again next week too. All right, let's get to our questions.
What should I do if I'm feeling stressed about the market?
Yeah, okay. Honestly, sort of the genesis of the videos that we started. So the first video that we did was on the 23rd of March, 2020. So lockdown happened here in California on the 16th of March. And, talk about fear, right? The fastest 35% drop in history. So you're losing money at the same time that you are, physically afraid of this virus. And I remember one, 24-hour period where I was answering emails almost straight through the night. And so I decided, really just in defense to try to record a video, send that out. And what I did in that video is I just tried to point out these are the positive things that are happening. And I think the problem that happens is it's so easy, and I've said this 100 times, to find the negative. It's everywhere. They can point it out to you. It sells. It's a lot more difficult to find the positive. Back then, at that time, we were talking about, look at Congress is pushing out all of this stimulus money. The Federal Reserve has lowered rates to zero. The Federal Reserve is doing quantitative easing. They ended up buying, $6 trillion worth? A billion. I can't remember, might be, of bonds off the open market to basically flood cash into the market to try to support things. And we ended up with one of the greatest runs that I can remember from that bottom, which happened just the next day. I recorded it on a Sunday, and that Monday was the bottom for that particular pandemic downturn. And we ended up with a massive run up, one of the best we've seen. And so that's kind of how I would handle the stress of the markets. Look at what's positive right now. So right now, obviously, the biggest positive is the fact that these companies are trying to race with each other to build out these data centers. And there are, the chip companies are going to make money. The real estate companies are going to make money. The construction companies are going to make money. The energy companies and the supplier of energy parts are going to make money. Networking, cybersecurity, right? All of this stuff is going to happen. And so, the expectation, the projection is for $4 trillion worth of spending on AI over the next 5 years. And that's been growing pretty much exponentially. So there's a huge positive. As long as that's happening, the stock market's not going to have a 30 or 40% drop when they're spending $4 trillion unless something else really big happens on the other side, right? And so that's a key piece. And then you want to take a look at the fact that the Federal Reserve is lowering rates. And they have a saying, don't fight the Fed, right? And it's a very good saying. So 8 out of 10 times, the stock market is up 12 months later after a rate cut. And the average rate of return is actually 12%, little bit higher than average. And so that's another positive. It's still going. There's still a 70% bet that there'll be a rate cut here in December. We just had a rate cut in September. There's another one in October. So to me, those are positives that you really want to try to take a look at. And again, that's the basis of this show and basis of our existence in this channel was to try to say, okay, if you want to be a balanced investor, you need to have some place you can go and see some of the positive things that are happening. And so we want it to be that side of the equation because I think it's actually less represented. And you look at kind of, what's going on in terms of development towards the future. There's some excitement in whether these turn out to be something or not. One of the positives that you have to focus on is what's the excitement in the market right now. There's a lot of excitement. Whether it's justified or not, actually in the short term doesn't matter. And so, they're excited about AI. They're also excited about global computing. Quantum computing. And so we're seeing, a big movement there. Thinking, of course, into the future that, AI technology would be better served by these computers that are incredibly fast, that the AI could learn faster or produce more or do more, those types of things. So excitement in the market is there. Take a look at the overall momentum. Yeah, maybe this week is down, but oh my gosh, I mean, the overall momentum in the stock market since the Liberation Day, bottom is very, very high. And so momentum continues until you really change direction. Mm-hmm. We're pretty far from changing direction. So as a positive, I'd be looking at it and say, okay, we haven't set a lower low since April. That's pretty good. Even now, even with the downturn this week, it's not a lower low. We're still setting higher lows, which is a key aspect of an upward market. Mm-hmm. We are still trading above the 50-day moving average. The 50-day moving average is still moving up. The 200-day moving average is moving up. We're trading above the 200-day moving average. The 50-day moving average is way above the 200-day moving average. All of those things are determinants for primary direction, right? And so we have a chart for that too, right? Let's show this. So when I look at this and I say, okay, and this is more from the technical side. So, okay, AI is working, we got rates coming down and all these positive things. That's some pretty strong momentum, right? And so that 50-day is the yellow line there. See, that's going pretty strongly up. We're still trading above that, just barely, but still hanging in there. And these are all like checklist things that you would look at when you're looking at primary direction. So the primary direction has been up really since, the April Liberation Day bottom. And so I would look at that and say, okay, until that momentum changes and we start to see a primary direction to the downside, I'm not going to get too nervous, right? And so that helps. And there's reasons it's doing that, and that's why the AI pieces are in there. So focus on the positive if you're nervous about the market, right? Because it's out there. There's a lot of it out there. And that's why I'm thinking at the moment that the market will continue to do well here for a while. I don't think we've reached that kind of blow-off crazy top that we're going to have. Now, that doesn't mean we can't have a 10 or 15% downturn. I mean, look at how many downturns we've had, even on this chart. And we still have a much higher stock market in that time frame. So that is normal. We can have those. But, are we going to have a 20% or more downturn, which is really where you start to change direction, right? Because that moves into officially a bear market category. So those are the things I'd look at if I was nervous about the market. I'd look at, I'd look towards these positive aspects that are out there. It's what we do on this channel as much as possible, try to point out, why these things are doing what they're doing. And we're not saying that we think the market's going to go up forever. That's not the point. The point is, if you're nervous, the likelihood is that you've been flooded with negativity, okay? And if you want to be a good investor, you want to also be flooded with positivity for whatever is out there, because even in the dark days of the pandemic, there was still positives we were able to point out. Turn out those positives were the thing that drove the market up into one of the best bull markets I've seen. And so there's always something you can focus on, and it just kind of gets you to a more even stance, and then you can kind of be better at analyzing, okay, does the positive outweigh the negative, right? Does the fire hose of positive coming in outweigh the negative that might drain all that positive off? Yeah, does that make sense? So that's a great question. All right, what else do we have?
Should I be worried about the AI companies after Michael Burry's shorts?
Okay, so this is actually a question that came in from a client this week. And so for those of you who don't know, Michael Burry, what was the movie called The Big Short? I think it was called The Big Short.
I think the book was Big Short by Michael Lewis.
Yeah, and so he shorted the housing market in some form or fashion, we'll keep it simple, and made billions in 2008 when everything fell apart. And so he's famous, and so he makes these statements on X, or what used to be Twitter, saying different things like sell. So the statement that he made this week was that he was I don't remember what the statement was, but in the end he was shorting NVIDIA and
basically
Palantir.
people were looking at his hedge fund's 13F report of what they were doing.
Right, and he's shorting two of the highest growth stocks that have potentially big potential to the upside, and he's shorting them. So, I mean, we do have a chart here just to show, because unfortunately, using him as a gauge for you, they invest differently, right? That I vaguely remember, but the time frame when he made all that money, he actually, prior to that, he'd started that short like 2 years before it actually happened.
Yeah, he had $1 billion under assets when he originally started that short, and a lot of money was called out by investors who were hanging in for the long run. Right.
So I mean, let's say you put in 100,000 and it's worth, or million probably in those cases, not for small dollar amounts, and it's worth $500,000, and you're kind of freaking out, and you're like, I'm out. It's too much loss.
Yeah, the market's saying, well, why is my account going down?
Yeah, exactly right. The market was going up. I'm losing half my money, and all of a sudden they bypassed. I mean, some of those guys must be kicking themselves because they probably could have turned that into a really big amount of money once that short did start to work. But these are all the different times recently that he has made calls, and they've been incorrect, right? So, stock market crash imminent. Markets up 11% over the next year. Global meltdown, World War III, no meltdown, markets up. Index fund bubble causes crash, markets up, no crash. So it just kind of goes on.
Yeah.
And go ahead.
I think Michael Burry is the type of investor he is he has conviction in his calls, but he understands how to cut his losses early.
Mm-hmm.
He doesn't ride his losses down. He'll sell out. It's 2023. He called at the beginning of the year that there's going to be recession, new rounds of inflation. But by the mid-year, his fund had closed out all those shorts. So
Right.
essentially, so he rides his winners very well, and he sells out of his losers.
Yeah.
And so it's a different type of investing style.
Yeah, so what's presented is this concept of, oh, this guy was right in this one time, and so he's going to be right all the time, and I should pay attention to that. But that's not how these guys actually work. They don't need to be right all the time. Maybe right 1 out of 20. And if they cut their losses on those other 19, or some of those 19 they're going to make up some money, they just need that one. And so when NVIDIA, if it falls apart, he makes billions off of that or whatever it might be. And so that's why, and now he's down to 4 clients, right? And
Yeah.
probably for defensive purposes, just because he doesn't want to have to deal with, all these people that are leaving. It's a brutal strategy. Lose, 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 lose. Bingo, and we make it. And so, if you're investing with him, you should understand that, and I'm sure they do. And so that's why they're sticking with it. But obviously that wouldn't work within our clientele. We couldn't sit there and say, okay, you're down 50%, but we're really, leveraged up and things work our way. We're going to be up 1,000% or something along those lines. Totally different type of investing. So you have to be really careful to, what you're following there as far as that goes. And I think what he's doing is excellent, but it's not for the average person. The problem is they're putting out these tweets, I think partly to enhance their position, right? Because if you start to, or maybe not in this case, because it was a 13S filing. But when you're saying sell, right? He did that one famous, sell, I think at beginning of 23. Is that?
Yeah.
And so, and you're shorting the market. That shouldn't be allowed, honestly. You shouldn't be able to have a big platform push out something that could actually make something happen that benefits you. But it's the way it is at this point in time. So
I think Michael Burry has historically been good at his predictions, but he's been poor with his timing, and that's another aspect of having having great predictions. You also need to have the correct timing to
yeah,
to
and you
really
got
make money.
you got to have that conviction to get you through that poor timing. So to stick with that shorting of the housing market in 2008 for 2 years, because he does that in 2006, the market actually was going up pretty nicely all the way till October of 2007. So that must have been really hard to stick with that and watch that short position dropping off, I would assume. And obviously the payoff was unbelievable when it works. But it's a totally different style of investing. So you just kind of have to take that for, as a grain of salt, just for, what you are and what you're doing. If you're the type of person that can sit with, your money in something that could drop in half before it finally gains, or lose 19 out of 20 times, even if you're cutting your losses, you're still losing before you get the one big hit. Nothing wrong with that at all, in my opinion. I don't have a single client that's willing to do that I can think of, especially with anything of substance. So you probably should be careful if you're not that person that's willing to do that in following somebody that is doing that, would be my point. Yeah.
Should I be buying this dip or selling the dip? How do you tell? You can kind of see today the market's almost back to even at this point, that people are buying the dip.
Yeah, exactly. The buy the dip crowd is strong, but to ask the question of should I or should I not, right? You got to have some rules or some thought process for when you would. There's nothing wrong with intuition either, especially if you're spending tremendous amount of time watching the market. I found my intuition tends to be a lot better than most of my checklists because I've been watching the stock market pretty much on a minute-by-minute basis since I was 12. I'm 61. Right, so you get kind of a feel Right now, I get a feel the stock market is going to continue to go up for a while before it falls apart, and that may not be true, but that's my feel. So that's part of it, right? What do you feel? What's your, what is your subconscious mind saying about the situation? What do you, tap into kind of how you're feeling about it. I would be buying this dip based on my feelings, right?
Mm-hmm.
But there are other things to look at, and we talked about this earlier, but I'll reiterate. I would be buying dips as long as the primary direction was up.
Mm-hmm.
And when the primary direction stopped going up, I would stop buying the dip. And so there are several pieces of that. Are you setting, if you look at the low back just over my shoulder there back in April, and you look forward, if you look, the lows that were established, the little drop downs, they're higher every single time,
Mm-hmm.
right? All of them, including this last drop down that we're involved with right now. And so that's key. I'm buying as long as that's true, right? Now, the first crack could come when if we're, the low we're at right now, even though we're coming back. This actually was a few minutes before things started to recover, but so we're a little farther off the 50-day moving average because this is not live. But nonetheless, if we get below that previous low, that would be the first sign. I'd certainly maybe cut back the dollar amount of my dip buying at that point, but I'd still be dip buying. The next one, of course, dropping through the 50-day moving average, having the 50-day moving average turn down, dropping below the 200-day moving average. All of these things are showing in a kind of in a progressive motion of change of primary direction to from up to down,
Mm-hmm.
right? And so as long as the primary direction is up, I'd buy the dip if that's what I was going to do. Now, we don't particularly do that here. We kind of are more of the buy and hold, but if I was a dip buyer, I would be looking at the primary direction as the main thing that would say, okay, I want to continue to buy. And, that's part of my gut feel for the reason I think the market's going up is because I'm watching the behavior of the dip buyers. They're not weakening at all, and they haven't since April. Look at the chart. There's not even, any substantive downturns whatsoever that have happened since April.
Yeah, and I know a lot of buyers, if you're still not feeling 100% either, or you could always split it and do a dollar costing. Maybe you have an extra $10,000, maybe you only put $2,000 in.
Right.
You don't have to put all your money in
Yeah.
whenever you see a dip.
That's right. And you can moderate and change the amount that you're buying based on kind of what's happening with that primary direction. I mean, a great example, I don't have that. Well, if I go back, let's see. Sorry. Get through all of these, should have turned it off. But a great example, just over my head, there was a 10% dip in the summer of 2023.
Mm-hmm.
Now, if you look at that, it still had the low, even though that low was 10% down, was still higher than the previous lows, right?
Mm-hmm.
And most of the checklist was still primary direction positive. If you would have continued to buy during the summer of 2023, it's hard to see that, but that recovery, remember, it made 9%, and that ended in October, and made 9% in 1 month in November of 2023, and it ripped up. And so not only should you have been holding during that period of time because it's still the primary direction up, but if you were going to be dip buying, that would have been a good place to do it, and you would have, recovered your money plus some because of the dip buying that you did. So I think that's a great example of a situation. Now, what happened here in April was the primary direction, technically on my checklist, changed and went down. Now, it didn't stay there.
Mm-hmm.
Unfortunately, the April thing was somewhat manipulated. Maybe not, that's not a good word, but because of what was said, it changed the course dramatically, right? So, got huge tariffs. No, not really. We're going to wait until July or what. There was this back off, and that really created this whole thing. So that was a little different. That was not a normal economic downturn. What we're dealing with now is maybe a little bit more normal. The price is too high. We need to sell a little bit, and the CEOs of these companies are seeing things, maybe eroding a bit. That's like a normal, real downturn. What happened in April was just purely based on, what Trump was saying at that time, which is, not, potentially an immediate economic event. So anyway, it's a good question. I think it's, worth answering. So, all right, well, that's our show today. Those are some good questions, actually. I really appreciate all that. And so We'd like to try to do this again next week. You can join us at any time as far as that goes. But we do have, questions that you can send in during the week if you'd like. Ask Tom with talkmoneywithtom.com is the email address. If you want to subscribe to the channel, you can do that. Hit the little bell button to get notified. And that way you can kind of keep up with what we're putting out there. And if you'd like to just meet with us directly, go ahead, book appointment buttons on our page. You can get to our web page here on the channel. There's a link, and then set up a 30-minute time to meet with Ethan and I, however you'd like, phone, in person, video, and we can answer your questions directly that way. So look forward to being able to see you again next week. And of course, we'll be doing some of the videos during the week about what we saw happening, on a daily basis, and look forward to seeing you then. Thank you very much.